Okay, so you want to own a construction company. You picture the trucks lined up outside a job site with your name on the door, a crew that respects you, a skyline full of buildings you can point to and say, "I built that." Big contracts, bigger checks. You imagine signing a deal for a new subdivision or a commercial build-out and watching the zeros stack up on the invoice. Here's the problem. Almost none of that is how this business actually works. That skyline you're picturing, most of the people who built it didn't get rich building it. The illusion is that construction is a high-margin trade because the dollar figures on every project are enormous. They are. The profit hiding inside those dollar figures is not. Let's start with scale, because the numbers here are almost absurd. The construction industry in the U.S. does somewhere north of $2 trillion a year in total output. There are over 700,000 construction firms registered in the country. Commercial construction alone moves hundreds of billions annually. Now here's the undercut. The average net profit margin on a general contracting business sits somewhere between 2 and 6%. Not 20, not 15. Somewhere between 2 and 6. You could run $12 million of contracts through your books in a single year and walk away with less take-home than a mid-level manager at a tech company. This is a business where the revenue is gigantic and the margin is a rounding error. And construction company isn't one business anyway. It's at least 4 different businesses wearing the same hard hat. There's residential building or remodeling homes, which is high-touch, relationship-driven and brutal on margin because homeowners fight you over every line item. There's commercial general contracting, office buildings, retail, warehouses, bigger contracts, tighter bid competition, and margins that get squeezed by the bidding process itself. There's specialty trade contracting, electrical, plumbing, HVAC, framing, where you're a subcontractor to someone else's general, meaning you get paid less, but you also carry less risk. And there's heavy civil, roads, bridges, infrastructure, which needs the most capital to even enter, but comes with government contracts that pay slower than a glacier moves and penalize you hard for delay. Now let's talk about what it costs just to open the doors, because this is the part where the fantasy starts leaking. Contractor licensing, depending on your state and specialty, runs somewhere between $500 and $5,000, plus exams and continuing education. Bonding, and you cannot bid most real jobs without it, requires posting a surety bond, and insurers want to see somewhere between $10,000 and $50,000 in working capital just to issue you a mid-size bond. General liability and workers' comp insurance, non-negotiable, somewhere between $8,000 and $25,000 a year depending on crew size and claims history. Equipment is where it gets ugly. Even a modest setup, trucks, trailers, basic power tools, a skid steer or mini excavator if you're doing site work, runs $80,000 to $250,000, and that's before you touch heavy equipment like excavators or cranes, which push into the hundreds of thousands per unit if you're buying instead of renting. Office and yard space, even a small one, another $2,000 to $6,000 a month. Add it up and you're looking at somewhere between $150,000 and $450,000 just to be in a legal position to bid your first real job. And that number buys you exactly $0 of guaranteed revenue, because in construction, you don't get paid until you win the bid. And you don't win the bid unless you can prove you're already capitalized enough to survive if the job goes sideways. It's a business that demands proof of financial strength before it lets you make any money. So where does the money actually come from? This is the part almost nobody outside the trade understands correctly, and it's worth peeling back layer by layer. The obvious layer, the one you're picturing, is the contract price itself. Client signs for $500,000, you build the thing, you keep what's left after costs. That's real, but it's also the thinnest layer in the whole business. On a fixed-price contract, your material and labor costs are estimated months before you break ground. And if lumber prices spike, If a subcontractor no-shows and you have to pay a rush replacement, if the site has unexpected soil conditions, all of that comes straight out of your margin, not the client's pocket. The contract price is the top-line fantasy. It is almost never the real profit story. The second, deeper layer is change orders. This is where a huge share of actual contractor profit lies, and it's a mechanism most homeowners and even a lot of first-time commercial clients never see coming. A change order is any modification to the original scope. Client wants a different tile, an extra outlet, a wall moved 6 inches. Because the client already committed emotionally and financially to the project, and because stopping mid-build to rebid elsewhere is enormously expensive for them, contractors can price change orders at 20 to 40% margin, sometimes higher, compared to the 2 to 6% on the base contract. A smart estimator will intentionally underscope certain gray areas in the original bid, not lie, just leave ambiguity, knowing full well that ambiguity becomes a change order later, at a much fatter margin. This is where the real money hides. The third layer is retainage float and payment timing arbitrage. On most large contracts, clients withhold 5 to 10% of every payment as retainage, released only at project completion. That sounds like it hurts the contractor, and it does hurt cash flow, but the sophisticated move is on the other side. Paying your subcontractors on 30, 45, or even 60-day terms while collecting from the client on 15 or 30-day terms. The gap between when you get paid and when you have to pay your subs is functionally free financing, and contractors who manage that float well can run their entire working capital off it instead of a bank line. The fourth layer, and the one that separates hobbyist contractors from real operators, is self-performed work versus subcontracted work. Every scope you subcontract out, you're marking up, typically 10 to 20% on top of the sub's price, just for managing them. But every scope you self-perform with your own crew, you capture both the sub's margin and your management markup. A general contractor who owns their own framing crew, their own concrete crew, isn't just building, they're vertically stacking margin that a pure, hire everyone out GC never touches. Now the insider trick, the mechanism almost nobody outside the industry has heard of. It's called fronting the schedule of values. On a lot of commercial contracts, you get paid in draws based on percentage of completion, and you submit a schedule of values breaking the project into line items with dollar amounts attached to foundation, framing, electrical rough-in, and so on. Experienced contractors will front-load that schedule, assigning higher dollar values to the early stage work like site prep and foundation, and lower values to the late stage finishing work, even though the actual cost distribution is more even. Why? Because it means you collect a disproportionate share of your total payment early in the job, while your actual costs are still low, giving you a cash cushion that carries you through the more expensive back half of the project. It's not illegal, it's negotiated openly in the schedule of values approval, but it's one of those things nobody explains to a first-time GC, and it's the difference between a contractor who's constantly cash-starved and one who isn't. Now the daily bleed, because this is where the fantasy really erodes. Labor is your biggest and most volatile cost. A skilled framer or electrician runs $25 to $55 an hour depending on region and trade, and every hour they're not billing a client is an hour you're paying out of pocket. Equipment maintenance and fuel on a mid-size fleet can run $3,000 to $10,000 a month even when nothing's actively broken. Insurance premiums, as mentioned, are already brutal, but workers' comp specifically climbs every time you have a claim, which in an industry with this much physical risk is basically inevitable over time. Financing carry, the interest on whatever line of credit or equipment loan you're servicing, quietly eats another few thousand a month regardless of how busy you are. And then there's compliance, permits, inspections, OSHA documentation, software for project management and estimating that runs $200 to $2,000 a month depending on your stack. None of this builds anything. All of it has to be paid whether you're actively on a job or between contracts. Every day your crew isn't on a billable site is a day you're bleeding 5 figures with nothing to show for it. Here's the structural risk, the one domino that can take the whole thing down. It's payment cascade failure. Construction runs on a chain. Owner pays GC, GC pays subs, subs pay their suppliers and labor. If a client, especially a single large client you're overexposed to, delays payment, disputes a draw, or worse, goes bankrupt mid-project, you are still contractually obligated to pay your subcontractors and suppliers because your agreements with them aren't contingent on you getting paid first. You can be sitting on a completed, high-quality job and be functionally insolvent because the money above you in the chain froze. This is structural, not bad luck, because the entire industry is built on a waterfall of trust that has no built-in circuit breaker. One client going dark on payment can take down a contractor who did everything right. For a real case study, look at what happened to Turner Construction's exposure during certain distressed retail build-outs in the mid-2010. Or, more instructively, look at the well-documented collapse of late-in-construction subcontractors during large mixed-use developments where the developer ran out of financing mid-build. But the cleanest, most publicly documented example is the string of subcontractor bankruptcies tied to the Hard Rock Hotel collapse in New Orleans in 2019. The general contractor, Citadel Builders, was managing a major hotel conversion when a structural failure caused a partial building collapse during construction, killing 3 workers. What followed wasn't just the tragedy itself. It was a cascade of subcontractor payment disputes, insurance litigation, and stalled receivables that stretched on for years, with multiple smaller trade contractors on that job publicly reporting they were owed 6-figure sums they never fully recovered, some of them shutting down entirely while the legal and insurance process dragged out. It's a stark, real illustration of the structural risk. You can perform your scope of work correctly and still get financially wrecked by something upstream, a design failure, a payment freeze, a legal entanglement that had nothing to do with your own crew's performance. So how do the smart, well-capitalized players avoid all of this? They don't play the same game. Large national contractors like Turner or Skanska or PCL don't rely on thin per-project margins at all. They run enough simultaneous volume that the law of large numbers smooths out any single project's disaster. They also self-perform far more scope than small GCs, capturing that stacked margin at scale. Some of the wealthiest players in this industry aren't contractors at all in the traditional sense. They are the people who own the equipment and lease it to contractors, or who own the real estate the projects sit on, and structure deals where the construction arm barely needs to be profitable, because the appreciation and rental income on the finished asset is where the real return lies. And the truly sophisticated operators use construction companies as a controlled cost center inside a vertically integrated development company. Build it themselves at near cost, then make the real money on the sale or lease of the finished property, where capital gains and long-term appreciation get taxed far more favorably than active contracting income. Let's put real numbers to the swing, because this is where you see the volatility instead of just reading about it. In a good year, a mid-size regional GC doing $8 million in contracts at a healthy 6% net margin, with strong change order capture and no major payment disputes, nets around $480,000 before owner compensation, plus whatever they saved through self-performed scope. In a bad year, same $8 million in contracts, but one client payment dispute freezes $300,000 in receivables for 4 months. Material costs spike 12% mid-project because of a supply shock, and a workers' comp claim bumps the insurance premium. That same company can swing to a net loss of $150,000 to $250,000, even while technically completing every job on the books. Same revenue, same crew. A $600,000 or $700,000 swing based entirely on timing, disputes, and cost shocks nobody put in the original bid. It depends on whether you have the working capital to survive a 4 to 6 month payment freeze without going under, because eventually, on a long enough timeline, you will hit one. And it depends on whether you're building relationships that generate change order heavy, trust-based repeat work, versus grinding out low-bid commodity contracts, where you're competing purely on price against contractors willing to work at 2% margin just to keep the lights on. Done with capital, patience, and a self-performing crew, this can be a genuinely durable, cash-generating business. Done as a low-capital, subcontract-everything operation chasing volume, it will quietly grind you into the ground one delayed payment at a time, and you will not see it coming until the day you can't make payroll. Construction was never really the product. It was the ability to survive the gap between when the work gets done and when the money actually shows up.